Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are talking about, see what the news is all about. It's going to be financial topic related. It could be wealth building, commodities, stock market, and maybe even the tertiary sectors around everything. I'm going to give you my financial opinions across everything. So I'm going to interject my opinions after all these things, and that's typically how I do it. If you guys want to follow me on Twitter, it's finding_finance. That's where you can find me, or you can join the website where we talk individual stocks, market setups, technical analysis, how we evaluate certain companies, different ideas around investing and stuff like that. That's finding-value.com, and you can join right now. The last day will be July 5th for $25 for the first month, and you use the code July 4th. It's in the description link. So coming in, Trend Spider. He says these three Bitcoin names have been on a rampage as of late. Keep them on your watch list. MSTR, I think that's Marathon Digital, and Riot. Another one is Hive. I did an option a while back on Coinbase at the bottom of Bitcoin, basically. It was when there was max fear in the market. It worked out fine. I basically doubled the position, and some of these could do very well going forward. That is a possibility. I don't invest in these things in terms of long-term investments because I don't know how to value some of the cryptocurrencies. So I'm not really a fan of them because I don't think they have a specific value or anything like that. So I generally stay away from things that I don't know how to value. I don't know what a good valuation for Bitcoin is. Some people say, oh, it's $1 million a coin. Well, I don't know about that. That's my whole thing. I don't know how to value it, so I stay away from it. But anyway, these are a lot of I think these are more of we'll call it crypto mining companies, blockchain mining companies, or whatever you want to call it. And that's what some of these are taking off. Technical wise, they look pretty solid. Don Durrett says Shiller PE ratio, which is the CAPE ratio, is at 31. It's at least 30% overvalued. The stock market is frothy, yet investors are bullish. What are they smoking? They're probably smoking a whole bunch of things. Hopefully, July 4th isn't getting them too high. But Shiller PE ratio, you can see it's at 31 compared to history. This history goes back to 1880. The average CAPE ratio over long periods of time is generally 15. We are double that. We're at 31. So we're way above the long term average. And I consider the average to be around 15, 16. This does to me look like it could be a kind of a double top-ish type pattern where you top once, come back down, come back up, and put in, whoa, a double top. And then we head on lower. Uh, Generally speaking, the times that these head lower are ding, 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 inflationary periods, increasing interest rates. And those two work together. That's what happened in the 1970s, came back down here. Also happened in the 1910s, 1920s, and it happened in the 2000 to 2008-ish era. I do think we have another inflationary period coming and that this is going to decline. We've got bar charts. Permabear Mark Wilson is beginning to doubt himself a little, but not really. Given how wrong he's been about the S&P 500 this year, Wilson has wondered if his earnings model might be misleading him, but he concludes the answer is no, and he adds that the rally is not impressive. Wall Street's leading bear is doubting himself a little. Here's what is worrying Morgan Stanley Mike Wilson's now. He has been calling for a market crash since 2022. And that's where I think some of these guys who are market predictors continue to get it wrong. And I think Trump, people don't make money off of making predictions. That's where I think a lot of people get things wrong. They make money by identifying where the value is mispriced in the market. And then you wait for that value to revalue itself during different market conditions. That is how Warren Buffett does it, Peter Lynch, and all these other guys. They find where the value is in the market. And generally speaking, they go after companies that are paying, they have positive cash flows, paying dividends, or making more earnings. And that's where they typically invest. And that's how they do it. That's their strategies. So here's Alibaba. So Alibaba, buyers refuse to give up this $80 area. Will this month's earnings be the catalyst for a move? Under inflationary periods and under a commodity bull market, a lot of emerging markets do very well. What you'll see is you'll see those currencies strengthen and you'll see the dollar weaken, and a lot of these emerging market companies will actually go up and do very well. I think that Baba right now is actually very low and could be a very good opportunity for a longer term play. Am I going to play it? I don't know. Haven't really decided. But this does actually look very good. It does look like it's bottoming. And it could be an inverse head and shoulders, just like this guy is showing. And I think it is attractively priced, and the market conditions are right for this to go higher. Pretty good alignment, in my opinion. Coming here, it's gold. Happy to see the continued calls for gold to crash. We've got a falling wedge. We've got an inverted head and shoulders. And I think eventually it's going to break the big long-term picture view. So this is it again, backed out a little bit. But the big picture view is what I like. This is just a gigantic cup and handle pattern. The handle's this guy coming on the right. The cup is this bottom here. Once we break above where this horizontal trend line is, or resistance line, we could see a big breakout move. Very similar to the, we'll say 2004-5 time frame where we broke out there. And that could be maybe roughly where we're at even in the overall cycle, equivalent to 2003 or something like that. Josh Young, the U.S. is the global leader in oil and gas production, producing as much as Russia and Saudi Arabia combined. So the U.S. energy powerhouse, producing as much hydrocarbon as Russia and Saudi Arabia combined. Here's United States, Russia, Saudi Arabia, Canada. So those are the big boy producers. We're doing, we've got plus 8 million barrels per day, 90 billion cubic feet per day for U.S. unconventional oil production. There are a lot of people who think that oil from shale could be topping out here at any second. We'll see if that's true. I do think that it's probably slowing down, and I don't know if it's topping or not yet, but we'll definitely find out. And definitely subscribe if you want to find out the answers there, because we're going to follow this. ASX, uranium, squeezing up big time. So this is on the ASX. Remember, we're closed for July 4th, but some of these markets are not closed. So we've got elevate uranium. We can see that we're squeezing in a falling wedge. That is generally a bullish formation to break to the upside. We've got the same setup in Bannerman, squeezing up, ready to break to the upside here. You can see we're turtle heading out. I think that we are going to see very big moves in a lot of these uranium companies. This is Paladin Energy. We've got the nice big green army showing up. It looks pretty good for a potential break. We'll see if it breaks. If this consolidates longer to the right, that's not going to make me mad either. Just waiting patiently for this to all unwind. Morgan Stanley, Mike Wilson, I talked about him, says he's been the biggest bear since late last year. If you missed any of his predictions, here is the compilation thread. This was back in 2022, November. He says a double-digit percentage drop will hit stocks in early 2023, says one of Morgan Stanley's chief investment officers, Mike Wilson. Wild ride. Morgan Stanley's Mike Wilson predicts double-digit percentage drop will hit stocks in early 2023. And he's been predicting it ever since. Now, again, identify the value, invest in that value, and wait. Don't I wouldn't be listening to these guys trying to make predictions like this, or predictions where the stock market's going to go, it's going to do a melt up, it's going to do this, it's going to do that. A lot of the times, those guys they get it wrong. What I would rather do is identify where the value is in the market, invest in the value, and be ultra patient for that value to turn in the market. Yes, you can use technical analysis. Yes, you can have uh, ratios that are favorable for your investments. And sometimes they just take a good long time to work favorably for you. You're waiting for those market conditions to change favorably where the assets get repriced. That to me is probably the safest, surest way to make money over long periods of time. Here are some setups that I've noticed. Urea ammonium nitrate back to support. Cocoa futures looking strong. Newcastle coal futures are back to support. So this is urea ammonium nitrate. This is fertilizer companies. Um, there are a couple fertilizer companies I really do like. I talk about them on the website. And we're back to that support level. So what happens is you break out, then you get a powerful breakout, you come all the way back to support. And what do I do on the back test? You buy the back test. So I'm going to buy this back test because we're on top, and I think we're going to get a big run out of it eventually. Cocoa futures is already kind of breaking to the upside here. We've had a squeeze. We've got a break to the upside, and it's starting to run. We are coming up to some resistance, so we're probably going to do a retest, move sideways for a little bit, potentially. And then hopefully we can work our way on higher if you want cocoa futures to go on up. We also have Newcastle coal futures, which is doing the same thing as urea and ammonium nitrate. We got the breakout, we've got the retest, and it could base here for a little bit, but this is generally where I start to look for potential investment opportunities in coal companies. Coming on down, it says, will this 1983 setup get us to the moon? I've seen this chart multiple times now. I even did an entire video on it. I don't think that we are in the same location, but it's possible that it does go up. It is possible. I don't think it's going to do it, though. The reason I don't think it's going to be the same is the valuations in 1983 were very, very low down here. Conversely, up here, they are incredibly high. I also think that the market conditions are radically different. In 2023, we have got an increasing interest rate environment. In 1983, we had a huge decline of interest rates from a very high level. So these were undervalued in favorable market conditions. This is overvalued in unfavorable market conditions. Even though these fractals may look like they align and they compare, I don't think they're the same. We can even go back up and I can show you the PE ratio. In 1983, we were down here. And right now, we are off the charts 31, basically, which is above the 1920s peak valuation in the roaring 20s. So that is the difference. One is charting it down here in early 1980s versus here where we're in an overvalued state. I don't know if these people who are posting all these charts, I don't know if they even know that. They're just trying to compare two fractals and say, oh, this looks the same. But I don't invest in things that are that overvalued. I stay away and I just go to where things are undervalued. So I don't think that this will be the same. It could happen, though, if we get massive inflation. So this can go up in nominal terms like this in a very high inflationary environment. But that doesn't mean that stocks are going to outperform other assets. Commodities could go up 2 or 3x that, or 4x that, or 20x that, depending on what commodity you're in. If it's precious metals, silver did some incredible things in the 1970s. It went up 50x. And I'm not talking about companies, I'm talking about the physical metal went up that amount. I think something like that is possible. Doesn't mean it will happen, but if we get a large inflationary pulse, I mean, stocks could still go up. I just don't think that they'll be gaining any value against anything else. Natural gas use for power continues to grow. The US has been cooler than the 30-year normal by 9% since May. I honestly don't remember the last time that happened. However, both May and June set new records for natural gas use in electric power generation. Whoa, 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 whoa. That's actually a huge thing there. We have a cooler than 30-year normal by 9% since May. And both May and June set new records for natural gas use in electric power generation. Man, we're going to eat through some natural gas here, guys. I think natural gas is at an incredibly good level, and I think a lot of the companies are at very good accumulation points given where natural gas is valued against oil, where natural gas is valued against stocks, and even gold. It says BHP knows a thing or two about copper mining. To frame it up, the world's going to need probably about 2 times as much copper over the next 30 years. That also, I think, is an incredibly good area. And keep in mind that renewables don't even have to happen. Copper demand will continue to increase. The renewable stuff, that's all like icing on the cake. I don't know if we have enough copper just to do air conditioning units in India and in China. We've got heating and we'll call it HVAC. We got lots of HVAC. We've got lots of refrigerators, ovens, and all those things that we are going to need to use, and copper plumbing, natural gas lines, all that stuff. Where we're gonna get copper demand go up dramatically anyway, just flat out anyway. All the renewable stuff's just icing on the cake, where it's going to throw it way over. Samantha Leduc says, "Do high interest rates fix high inflation?" She thinks no, they cause it. I don't think Fed cares so much about what you think they do. Wages and unemployment can move higher. Fed still won't hike or cut, respectively. It's all about the debt. Um, so let's go in here and see what she means by this. It says the only thing Fed cares about is keeping US yields, USD and oil from moving too high too fast and outside of the Goldilocks zone, which keeps equities bid. Given the outside money printing and deficits that have been created, stagflation beats hyperinflation or deflation. How does Fed inflate our massive US debt away and keep stocks bid with liquidity if inflation is falling? The Fed is trapped. Fed needs inflation, Treasury needs inflation, even the White House needs inflation. Stagflation beats default and austerity. The only other way US debt falls is if they stop printing money and stop spending through stimulus. Is that going to happen anytime soon? She thinks hell no. So inflation is the best way to drive assets, stocks, RE, etc., higher while lowering the value on the US debt. Added benefit is it helps keep liquidity flowing and backstops banks. Not to mention, given time for MBS and credit markets, especially commercial real estate, to not implode. Also, equity markets returns need both fiscal spending with the Fed QE printing, especially as tax receipts fall. Otherwise, we will suffer from inertia, and we know what happens when gravity takes hold. So the risk now is if inflation falls meaningfully, hence the Fed pauses. Goldilocks is still in the house. Yes, equities have priced in a hawkish pause, while bond markets keep talking their depressed books of cuts. Only the Fed is talking hikes. They have to keep the confidence game going that they are beating inflation when the truth is they are manufacturing it 100%. For equities, yield staying under control from loose monetary policy while USD goes sideways, thanks to the BOJ bond buying. At the same time, oil is range bound, forcing speculators to exit. It's great backdrop for higher end market structure proves this out. So what we witnessed here is the perfect macro intervention collar supported by perfectly bullish institutional positioning. I don't even know what that means, guys. The perfect macro intervention collar supported by perfectly bullish institutional positioning. So why do you think the Fed wants inflation lower the equity with equities? I say they lie and see no harm, no foul in letting equities melt up for the host of self-serving reasons. Even better if equities run hard. I secretly wonder if Fed is forcing this melt up in equities so that when they force the rotation out of equities, read volatility, traditional R-par once again makes a cameo appearance where bonds get bid up forcefully. I mean, every macro manager is worried about who will support bond buying. I say Fed has a plan. Panic. And she keeps going. I'm not going to read all of it. That's good enough. But yeah, that's possible too. We can see that PMIs for June came in below consensus to new cycle lows. Here we are here. Now, my take on this is I would want to be buying down here. I wouldn't want to be selling. This is a buy point. This is a buy point. This is a buy point. Whenever you get a turn higher, I would say those are buy points. I would say we are closer to PMI going back up potentially than we are it going down to say 30. So when it gets to certain levels, I would start to cost average into certain companies or certain sectors if I saw a chart that was down this low and starting to turn higher. Here's Luke. He says U.S. shale has represented 90% of global oil production growth over the past 10 years. That means this down below is foreshadowing reduced oil production, which means is foreshadowing stagflation, not deflation. When the bond market figures this out, things are going to get interesting. I agree. That's where the oil, you basically just have inflation. You got credit growth growing at a faster pace than GDP, aka PMI. And that's what I'm going to stop it there, guys. That's what we've got for today. If you guys enjoyed the clip, give me a thumbs up. Subscribe to the channel. Subscribe to the website if you'd like. Again, July 4th in the coupon code if you want that. And that's all I've got for today. Hopefully you guys had a good 4th. Hopefully you guys didn't do anything too crazy. And we'll catch you next time. This is Finding Value.